Well, good morning. Looking at my watch, we would like to start with this webinar, and I would welcome everybody to this webinar that is a Prime Global initiative of Carpenter Box and Joanknecht in Eindhoven. Shortly, I want to introduce Prime Global, which is an independent association of accounting and advisory firms. And we are located in 100 countries all over the world, which part of our association is approximately 300 member firms. And the purpose of our association is to provide and create trusted relationships all over the world, learning and promote business opportunities. Well, this webinar is an example of this purpose, and I especially want to welcome my UK colleagues, Tony Summers, Dan Hobbs and Anthony Davies, who will be our host for today. But Tony, before I hand over to you, I have two things. If somebody wants to interrupt or has questions during the presentation, that's a possibility, of course. And second of all, I would want to share some news flashes that come into the Netherlands about the situation in the UK at the moment. So I got some of them, and well, you might, kicking off this webinar, react on them. What we see in the Netherlands, Tony, is that job vacancies in the UK rose to a record of nearly 1.2 million. And also, well, people queuing at gas stations at the moment to fill up their car with gasoline. And there should be a shortage of, well, fuel as we hear it. And also, we see that labor shortage has led many fruit and vegetable farmers to cut their plantage for 2022. And last but not least, there's an expected shortage of turkey around Christmas. So in the UK, and that's an important one, I think. Anyhow, Tony, I would like to hand over to you. And well, we are curious about the British view on the developments that I just mentioned. Thank you very much.
Thank you. It sounds like you're getting half the picture, I think is probably fair to say. Yes, the UK has had some issues. We have had lots of queues for petrol, but we like queuing, so that's not such a bad thing. Yeah, there wasn't a fuel shortage. It was just somebody started a panic session, and all of a sudden everybody thought the fuel was going to run out, and so we queued like the British do. So I think we're all good. We've got certain parts of the economy that are booming, other parts that are struggling, waiting for the hospitality sector to really kick off again. So I think there's a bit of a perfect storm going on with Brexit followed by COVID. So the two of them together has caused some issues. We can't hide from that. But thank you for that introduction, for making the UK sound like it's really struggling. I think the others would echo that we're not. It's business as usual, and so I think, yeah, we're all good. We're still trading. We're still open for business. So I think I'll probably start with who are we. So my name's Tony Summers, as it says on the screen there, and I'm a partner in Carpenter Box, and I head up our international services team. And on this webinar, we've got Anthony Davies. He's a partner specialising in international tax issues, and Dan Hobbs is a partner specialising in indirect taxes, predominantly VAT and duty, and you'll be hearing from them shortly. A bit about us. I'm not going to cover all those points, but basically we are a multi-award-winning firm of accountants with over 200 people. We're all based in the south of England. The firm, as you can see at the bottom right-hand corner there, is soon to celebrate its 100th birthday, which will be nice, but I don't think we get a telegram from the Queen for that, like the rest of us do if we manage to get to 100. We've got 4 offices, 3 on the south coast, one near Gatwick Airport, which is the UK's second largest airport, with ironically quicker links into the centre of London than Heathrow has. And the Gatwick office, where Anthony and I are based, is also next to one of the largest industrial parks in Europe, which boasts a very wide variety and diverse number of companies, including many large household names. Now, in this presentation, we're going to cover a number of areas, and I'm not going to cover all of those services that we provide, a number of areas. Firstly, I'll cover some of the practicalities of setting up in the UK and the compliance regime that you will be faced if you're operating in the UK, all from a relatively high level. So I'll skip through those things. Then Anthony will run through a few sort of scenarios or case studies on some key tax points that you probably should be aware of. Then he'll hand over to Dan, who will talk about some of the VAT and duty issues, particularly following Brexit, which has obviously been a very hot topic and subject of many webinars that we've been doing over the last year. And then to conclude, Dan will talk briefly on the current economic outlook or environment for the UK and where that tax landscape is likely to go in a sort of post-Brexit and post-COVID world. And then we'll be happy to answer any questions. But I think, Mark, as you introduced it, we're happy to take questions as we go along. So please feel free to interrupt us. So I'm going to cover quickly setting up in the UK. So if you were looking to set up a new UK company, for example, and I'm going to leave branches aside because I think Anthony's going to pick that up a little later. If you're setting up a new UK company, you've got two choices really. 99% of, or probably more, of companies from the Netherlands will set up a limited company. So I won't go too much into a limited liability partnership because it's probably not too relevant, although it might be something you want to add into the structure at a later date. To set up a company is relatively easy. You need some information, none of which is too difficult to obtain. And we can set up a company, for example, at Companies House within a few minutes. One of the things that you will need is a director. That director does not need to be a UK resident, but it's helpful a little bit later when I come on to setting up the bank account. And you need a registered office. Now that has to be a physical place in the UK, but it doesn't need to be a place that you trade out of. So for example, we've got clients where their registered office is, for example, our office where we're sitting right now, and their physical office doesn't exist because they all work from home or they don't actually have any employees in the UK. So you can have a company with that particular setup. All that the requirement is that registered office must be in the UK. Now, I mentioned setting up a bank account. It is very difficult to set up a bank account if you don't have any people in the UK. In fact, I'd say it's probably near on impossible. So you would need someone in the UK to be on the bank mandate, and it certainly will help if it is a UK-based director of the company. Without that, it does become difficult. And you might well use ABN AMRO, for example. They might be able to be more helpful in that respect, but generally it's very difficult. The other thing I've got on that little screen in terms of setting up the company is you will almost certainly need digital accounting records. So, for example, if you are submitting VAT returns, then the tax authorities expect you to be doing that directly from the accounting software, so that there's no manual intervention in between. There are some exceptions where you've got complex VAT situations or groups, but yeah, so we recommend generally for overseas companies that are setting up that they have a cloud accounting system, not least because one, it does all that interaction with the tax authorities, but two, you can have visibility of the live data as well remotely. When you set up in the UK, there are a number of tax registrations, and I'm going to whistle through these quite quickly. The corporation tax is set up automatically. You are registered automatically when you set up a new company. When you get a payroll, you have to register that. And so you get registered for all the payroll taxes, and there are fines if you don't submit those on time. You need to have a workplace pension. That needs to be set up where you have employees in the UK. And VAT. You don't need to register for VAT, assuming your taxable or VATable turnover is lower than 85,000, but quite often it's advisable to do so if you're trying to recover some of your costs, your VAT on costs that you've incurred in the UK. So yes, you would need to register for VAT. More compliance, accounts. You have to file statutory accounts at Companies House. Generally, those accounts will cover a period of 12 years. That's the sort of default, 12 months rather, not 12 years. But they can be shortened or lengthened to sort of accommodate group reporting or be the same as the parent companies. Those accounts need to be filed 9 months after the company's year end. Again, there are fines if you go late. Corporation tax returns, you've got 12 months after the year end to file one of those. And they are for 12 months. So I mentioned you can have an 18-month period. If you've got a 12-month period maximum for a corporation tax return, you can see that you're going to have to submit 2 tax returns for the same period or for the same accounting period. There are audit requirements in the UK for companies that breach 2 of those 3 limits. So for example, if you're the company turns over more than 10.2 million or has a balance sheet asset total, so that's fixed assets plus current assets of more than 5.1 million, or you have more than 50 employees, you reach two of those three, you have to have an audit in the second year that you breach those limits. The thing to bear in mind is those limits apply to not just the company, but the group that it is part of. So if you are a well-established Dutch company, you've got other subsidiaries around the world, you exceed those limits before you even start in the UK, your UK company will require a statutory audit. Now, if your UK company does not exceed those limits, but the group does, it can still file accounts that don't show its P&L and don't show its director's report. So it's a sort of what they call filleted set of accounts. So you're not putting every bit of information out there, but you will still need to have an audit in that scenario. There are something called confirmation statements, which are filed every 12 months. That just simply tells Companies House whether there's been any change in ownership. Where there hasn't been, it's a nil return, but it is a criminal offence not to file those things. VAT returns, I'm not going to spend too much time on those. Generally, most companies tend to go for a quarterly filing, and you have 1 month and 7 days to file that return. Again, there are fines if you're late, but if you're using for a reputable firm of accountants, shall we say, like us, you won't have that problem at all. Payroll, again, if you've got to have submitting returns on a monthly basis on the payroll. I won't go into too much detail there. One thing at the bottom there is a table that I've included for completeness about national minimum wages that you have to pay people. So if you're looking to set up companies, that's the minimum amount that you can't go below those hourly rates. That's not an annual or monthly salary, unfortunately. That's an hourly rate. On the workplace pension, I don't really want to say too much more on that, other than there are various different requirements that you have to make and submit returns on a monthly basis on doing those. There are various other compliance issues there that I've listed. I think these slides we'll send over so that they can go to all the viewers, so that you can see the requirements that you've got, but I'm not going to go into too much detail on any of those. And at this point, that's given you a sort of overview, if you like, of the UK compliance and setting up in the UK. We'll go into some case studies, and I'll hand over to Anthony.
Thank you very much, Tony. We're just going to talk about a couple of scenarios that arise commonly here in the UK when overseas companies come to operate in the UK, and things that can trigger particularly tax issues, but also filing requirements in the UK. So scenario one looks at employees moving to the UK. And in a more globally mobile world and digital world, we are seeing this more and more, where employees are allowed to work wherever they wish around the world, not just from a country perspective. And we see a lot more globally mobile employees coming into the UK. And employers need to be a little bit careful when employees come into the UK, because there can be tax and social security contribution issues. If an employee is undertaking their duties in the UK, then the company may be required to set up a payroll and withhold tax and social security contributions. There are some short-term exemptions from social security contributions that may be available in certain circumstances. But broadly, if you have employees working in the UK and undertaking their duties, there is likely to be a withholding requirement and some compliance and filing requirements here in the UK. Quite often people or companies don't realise this, or employees move and don't set up the required payrolls and withhold the tax at source, and it can cause serious issues and penalties if it's not dealt with properly. An employee can cause what we call a permanent establishment here in the UK. So under the double tax treaty between the UK and the Netherlands, an employee's office can constitute a permanent establishment. It would usually be necessary for employees to be able to conclude contracts here in the UK before a permanent establishment would be established. So care needs to be taken if you don't want to create a taxable presence here in the UK and pay UK tax, because you may inadvertently do that if the duties of the employee are able to conclude contracts. Can we move on to the next slide, please, Tony? It's a hugely, incredibly complex area of tax law. The basic principles are the employee is taxable in the country in which they undertake their duties. And officers and employees undertaking their duties in the UK will likely, as I said, trigger a filing requirement. And senior employees, such as directors, may be assessed by HMRC and be responsible for operating the PAYE and NIC in the UK on behalf of their employers if their employer isn't based here in the UK. So it can be an administrative burden upon the employees that they're not aware that they're going to have to comply with. Also, I think as Tony mentioned before, there are pension requirements, but there are many more UK employment law related issues that employers need to be aware of, such as ensuring that employees have the correct annual leave, training, pension contributions, health and safety, etc. So employers need to take advice before they allow employees to move to the UK. Next slide, please, Tony. Thank you. The second scenario is kind of the next level on from an employee moving, which is that a foreign company sets up a UK branch here in the UK, and double tax treaty sets out what can constitute a branch or a permanent establishment. And this may be chosen where the company does not wish to operate a separate legal entity within the country. Often it can be done at the beginning of a period of entering into a new jurisdiction. Could be commercially. In some countries, there's an automatic offset of losses for foreign companies that operate via a branch. I understand from conversations with Peter Paul that there's an exemption in the Netherlands for branch profits and losses, and therefore that may not apply particularly for the Netherlands. It's important to understand that the branch still needs to register for tax purposes and file its parent company accounts with Companies House, who regulate all companies here in the UK, and will be subject to UK tax on profits attributable to the branch. It is possible, though there is legislation, there is restructuring legislation in the UK that a branch could be converted into a separate limited company later via an incorporation if required. And very often when companies are looking to set up operations in the UK or in new territories, it may be that they set up as a branch first and incorporate into a limited company later on. Scenario 3 is we're going to talk about limited company. Next slide, please, Tony. So this is looking at separate operating via a UK limited company, and the benefits of this are it's a separate legal entity and often can help to ring fence the risks of trading in a different foreign country. There's often additional there is additional filing requirements and slightly more onerous filing requirements. The UK company will need to prepare its accounts and tax returns and ensure that it complies with all aspects of UK law. It may be that local suppliers are more likely to offer better trading and credit terms to a company based in the country. And quite often, the decision to set up a company is commercially driven rather than tax driven, but we have to be aware of the tax implications of setting up a company. We've put the tax rates down there, but I've got another slide that goes through the tax rates in a little bit more detail. If we can move on to the next slide, please, Tony. So our current tax rate is, corporation tax rate for companies is 19%. This is a flat rate. So all profits from nil to wherever the profits may end up subject to 19%. The government have already announced that this is expected to increase to 25% from 2023. The UK often is an interesting country because dividends received by most UK companies are exempt from tax in the vast majority of cases. There are some exceptions to this rule, so dividends received by dual resident companies are not exempt, and we can elect out of the exemption if there's a more beneficial reason not to be utilise the exemption. We do have a withholding tax on interest and royalties. There's no withholding tax on dividends or dividends paid out of the UK do not suffer any withholding tax. So it often makes the UK quite an interesting place as an intermediate holding company, maybe. And those statutory withholding tax rates can be overridden by the double tax treaty. I think the next slide gives us the rates, Tony, on the double tax treaty between the UK and the Netherlands reduces all of those standard statutory rates down to 0. There's not really much else to say on withholding tax rates because they are fairly low because of the double tax treaty. So if we can move on, please, Tony. Overseas companies and residents, and there's only really one point that I want to kind of pull out of this slide, and it's the dual residency aspect. So typical residency rules are that companies are tax resident, whether incorporated or centrally managed and controlled. The OECD set out a project in 2008 to change some of the rules around tiebreaker clauses. So when a company is resident in multiple jurisdictions, what we call dual resident, the UK-Netherlands tax treaty now says that we need to check and the competent tax authorities need to agree whether that company should be resident. And this can become a problem if we've seen this be a problem historically for UK intermediate holding companies. So if you invest indirectly to other jurisdictions via the UK, and the UK is dual resident because it's centrally managed and controlled in the Netherlands, but incorporated in the UK, then we would need to make sure that the competent tax authorities agree that that company should be taxed in the UK. Otherwise, we may have an issue with paying dividends through and applying the dividend exemption, which wouldn't give a very nice answer and could create a tax liability where none needed to be created. The challenge with getting competent authorities to agree is that they can take a long time. It's not a short process, and writing to each authority and then getting them to agree can take a significant period of time. So it's something that we have done historically with some clients. Next slide, please, Tony. There are some additional rules for large businesses and groups of companies. We adopt the standard OECD guidelines on transfer pricing, and larger businesses need to apply transfer pricing policies. There's an exemption for businesses broadly with a turnover under 50 million euros. Profit fragmentation is very similar to the transfer pricing regime and deals with smaller businesses and looks at businesses operating in low tax jurisdictions. For large companies and groups with taxable profits over £1.5 million, there are different payment requirements. So typically a company would have to pay their tax liabilities within 9 months and a day after the end of the accounting period. Larger businesses are required to make quarterly payments on account up front and then make a balancing payment at the end of the year. And also large businesses need to ensure that they publish their tax strategies online. If they don't, there can be fines for not doing so. Obviously, that's quite a brief run through of some of the international issues, and there are lots of issues. So if you have any questions, please feel free to ask them in the chat box. And I'll hand over to Dan to talk about VAT customs and Brexit.
Thanks, Anthony. So the UK VAT system is very similar to that across the rest of Europe. So our VAT system has been based on the EU VAT directive, but Following Brexit at the beginning of this year, we are now starting to see some divergences that I'll come on to. But I think most importantly, now the UK is no longer part of the single VAT union, there are more VAT considerations for cross-border trade between the mainland and the UK than there has historically in the past. And I think one of the key importances in all of this is the Incoterms that are applied to transactions. So, I mean, we've been finding with many UK businesses in particular, Incoterms when trading with the EU have been largely unimportant within a single VAT union. Who's responsible for VAT and duties was largely moot because the EU VAT directive determined that. Now we've got a separate union, the EU, from the UK system. The Incoterms will generally determine who is going to be responsible for various VAT obligations. So I think some of the key ones I just wanted to briefly mention are listed there on the screen, really. Now, if you're dealing under DDP terms, which tends to be quite common in contracts, particularly if they're not really thought about, it just tends to be a fairly default position. That means you, the supplier, are going to be liable for all VAT and duty obligations. So if you're a non-UK business sending goods into the UK under DDP terms, you will almost certainly have some UK VAT obligations, which I'll come on to. If you're dealing with any of the other Incoterms, so some of the other common ones, ex-works, meaning that your customer is responsible for collecting goods from your location and clearing the other side, or DAP, which is another fairly common one, delivered at place, where the terms are substantially similar to DDP in that the supplier is responsible for making sure the goods make it to their destination, etc., etc. But crucially, it is the customer who is responsible for, you could say, clearing those goods and paying any import VAT and duties that might be due. So next slide, please, Tony. The key things that a non-resident business need to be aware about when transacting with the UK are what our rules are around VAT registration and who is responsible for accounting for that on various transactions. So Tony mentioned earlier that there's this general threshold of £85,000 for resident companies, which allow businesses to trade up to that threshold without having to be VAT registered if they so wish. Unfortunately, there is no such threshold for non-resident businesses. So unless you're setting up a UK company, if you're operating a branch or similar or otherwise trading within the UK, if you're making any sales to UK consumers or businesses, you potentially have a UK VAT registration requirement. We also had a change in rules at the beginning of this year from 1st of January in terms of distant sales into the UK. So where a business anywhere in the world is selling goods to a non-VAT registered person in the UK, if the consignment value, and by that I mean the total value of the package coming into the UK, is no more than £135, then that seller is required to be VAT registered in the UK and account for VAT on those sales. So that's particularly going to affect online retailers. So whereas before an online retailer would have the advantage of relying on the old distance selling thresholds into the UK, that no longer applies. So if you're selling, whether it's through an online platform such as Amazon, your own website to consumers in the UK, you may have an immediate VAT registration requirement over here. Where the consignment value is more than £135, then import VAT and duty will be due on those goods coming into the UK. But it could be beneficial to consider a voluntary VAT registration in those circumstances. But as I touched on a minute ago, if goods are located in the UK at the point of sale, perhaps you've got a fulfillment centre over here, perhaps you're responsible for clearing the goods into the UK under DDP terms, then you will always have to be VAT registered in the UK because we don't have that threshold. But all of that, of course, applies to B2C sales. It's a little bit easier if you're dealing with other businesses. Provided your customer in the UK is VAT registered, then you're not going to have any UK VAT obligations. Again, provided that you're not shipping to them under DDP terms where you are the importer of record. In those circumstances, provided you can obtain the VAT registration number of your customer, your customer will be responsible for accounting for that VAT due and will in most cases be able to recover it through their own VAT return. There is still then the question of duties, but that again comes down to what Incoterms you've agreed. So it can be a little complicated for B2C sales in particular. For B2B sales, I think that the key message that I want to give to people is look at those Incoterms, see what you've agreed with your customer. And generally, if you're selling to businesses in the UK, it's mostly going to be beneficial for you to be transacting on terms other than DDP, so you don't have those registration requirements and all the other filing responsibilities that go with it. So if we can just move on to the next slide, Tony. So, following Brexit, COVID, and just the general state of the economy at the moment, what is the outlook for the UK kind of tax environment at the moment? Anthony mentioned earlier, we've already had an announced rise in corporation tax for a couple of years' time, going up to 25%. Not expecting anything further for the time being, but that would probably be the highest that the UK corporation tax rate has been in probably about 15, 16 years now. And we've got a new health and social levy that's been introduced in the UK as a kind of a bit of an addition to national insurance that we have here. So not too much, 1.25%, but nevertheless is expected to raise a lot of revenue for the UK tax authorities. And that levy also applies to our dividend taxes in the UK for individuals. I think where we might see the biggest changes going forward is in relation to VAT in particular. When we were part of the EU VAT union, we were very restricted as a country on what we could do. We have to follow the central EU rules, as all countries in the union have to. And in particular, that restricted the ability to charge certain things at lower rates of VAT, in particular a zero rate. So in the UK, we've got a zero rate that applies to a whole number of different supplies, from building and construction work to food and some other things. And there have been public pressure in the past to kind of increase the scope of that, but we weren't allowed to under previous rules. So there is a lot of expectation as the years progress. There may be some movement in VAT rates that are charged on certain supplies in the UK, but we're still in the very early stages of that. So it's very much a watch this space at the moment. So that was kind of a bit of a brief overview of some of the kind of the VAT and some of the outlook of kind of UK taxes over the coming months. And I think that's all we were going to cover, but we've now got time for any questions that anyone may have. So is that over to you, Mark? You looking at the questions?
Well, I think, Tony, you have the questions coming in, maybe on the chat, or I'm not sure, but I have a question of myself. That is, well, we see in the presentation some rising of percentages of tax that is going to be paid in the next few years. During Brexit process, expectation was that taxes would go down, but reality is taxes go up, and some promises or expectations of some regions that taxes or VAT will be 0% is still there. What is the reality of this expectation? Can you tell us a little bit about that?
Yeah, sure. I think the UK, we've had a little bit of a change in direction on some of these things, and it has largely been caused by COVID. Brexit was promised as this thing which would give us more control over our own taxes and the ability to reduce taxes in certain key areas, tax incentives, VAT, etc., etc. Like most countries across the world, as a result of COVID, we've now got a very big budget deficit, and in order to pay for that, there has been the need to raise taxes in some areas. So the general outlook at the moment seems to be that for a typical person and business in the UK, there is going to be a slight increase in taxes through things like the social security levy, the increase in corporation tax, etc. But the tax reliefs in the UK are now going to be more targeted to sectors and industries in which we want to grow. So there's a big focus in the UK in things like technology at the moment, film, video games, agriculture to kind of protect our production there. And that's likely what we're going to see increasing amounts of, certainly in the short term, rather than general tax cuts across the board, rather tax cuts aimed at particular industries and sectors which the UK are keen to grow and develop.
So maybe in reaction on that, it would be nice to hear what your experience is if it goes to businesses coming in from the Netherlands, like the last year, the last 2 years, and which kind of businesses these are. What might be the reason to come to the UK? Since it did is there some overview on that, on your perspective?
Yeah, I mean, I would comment that businesses that are operating in kind of technology and manufacturing sectors in particular, they're likely to see some kind of good tax breaks and reliefs going forward. So the UK's got quite a generous research and development tax relief scheme where you can save money off your corporation tax bill, or in some cases get repayable tax credits. It was announced in the last budget that there's a consultation to potentially expand that. And that generally affects companies that are in the technology sector, inventing kind of new products and processes to improve technology. But indeed, manufacturing companies will often fall within this regime where they're inventing new ways to manufacture products in kind of enhanced ways. We've also got a generous tax relief system now for investment in capital items. So there's a kind of a special 130% tax relief that can apply to investment in kind of capital items such as machinery, office furniture, you name it. But again, it kind of lends itself very well to those capital intensive businesses that are going to spend a lot of money setting up in the UK, and they've got that big capital outlay at the start. I think the businesses that aren't likely to kind of see any love, as it were, from the UK government in terms of tax relief are perhaps, retail sector in particular. I think that landscape is going to change dramatically over the years as just everything becomes more international. It becomes easier to trade international, and how each country kind of gets their share of the taxes, as it were, on kind of sales to local consumers.
Maybe as a last, and then I will make space for other people. But what we always thought was when businesses come into Europe before the Brexit, they come in, especially from the US side, they come into the UK, and then from the UK they go to the mainland. Since Brexit, that is of course, less possible for the US companies to go first to the UK and then go to the mainland in Europe. Do you have experience on that? How this?
Yes, that's a very interesting question, actually, because we historically and I deal mostly with VAT matters, and that was always a key consideration. The UK, as you say, was often a hub to kind of import goods into Europe and then distribute elsewhere. But there is now this problem with using the UK as that hub because of the new hard border we've got, not being part of the union anymore. So once upon a time, it was quite easy for those companies to come into the UK, then just ship all the goods around Europe and rely on distant selling thresholds and all of the VAT reliefs under that. Now we've got the new border, and we've got the IOS scheme and the OS scheme as well for distribution of those goods. It actually becomes more difficult routing those goods into the UK. So certainly we're already finding that businesses that used to use the UK as a hub are now turning to places like the Netherlands in particular because of the transport links and how easy it is to import goods from, China and elsewhere in kind of the Asia where the goods tend to be manufactured. That we're seeing a lot of them instead turn to the Netherlands as their kind of EU hub, and instead then bring some of those goods back into the UK for distribution to UK consumers. So yeah, I've certainly already seen a shift in that.
Okay, thank you, Dan. Let me check. I have some on the chat. Thea Den Hartog. Thea has put in some question. I don't know if she's able to to get it in, but she says, "Hi Tony, regarding VAT, is it correct? There has been a lot of confusion about VAT on invoices from the Netherlands to the UK. We got this from text from our customer. We would like to add that I've spoken to both our accountants and import department at Gender and White, and they both agree you should not be charging US VAT under the DDP option. You might want to look into this again, as perhaps there has been a misunderstanding." Something like that.
Yeah, there has been lots of confusion about VAT invoicing for supplies to and from Europe, and as I said earlier, that the kind of the Incoterms are incredibly important there. But the short answer is, if goods are being shipped from the Netherlands into the UK under DDP terms, then it is the supplier's responsibility, i.e. the Dutch company, to register the VAT in the UK. They will then be able to recover any import VAT that's being charged on those goods coming into the UK, and then they would be responsible for charging UK VAT on those supplies. So, as I mentioned, generally, if you're sending goods from the mainland into the UK, you're better off doing it under, say, DAP terms or similar, so the customer can be responsible for that UK VAT.
Okay, so if maybe if the problems are still there, that it's possible that they can contact you straight away.
Absolutely.
On this. That you can have this discussion together, and maybe there's a solution on this. So that is what I can see in the chat box for now on questions. So if we have no further questions left, and
I do have one, Mark-Jan.
Okay.
It's more based on what we see happening in general, is that given the disruption in supply chains in the Netherlands and also in Germany, we see a lot of companies trying to build up their stocks, so building up warehousing capacity. I could imagine that this is also happening in the UK, because companies serving the UK market might be running into supply chain issues, might be running into red tape at the border. One, do you see this happening? So foreign companies building up stock in the UK to be able to serve the market more quickly? And as a consequence of that, are there particular setups that generally work better than others? So for instance, does it make sense to incorporate a UK company for that purpose? Or are you like saying a foreign entity having the right registrations in the UK will get you the same result?
Do you want to take that, Anthony?
Do you want me to take that one? So I think the answer is we have a number of supply chain issues in the UK, and I think you mentioned the fuel issue earlier on, and actually that came from a supply chain issue where it was reported that there was a lack of drivers to deliver fuel to the petrol stations, which actually turned out not to be too true. But Tony mentioned that we are based just outside of Gatwick Airport in a trading estate called Manor Royal, and I think if we look at the development of that trading estate, it's one of the largest trading estates in the UK. Lots of the buildings and the property in Manor Royal particularly are being converted into warehousing space, and I think that is a key indication of the need for further warehousing here in the UK, and the push for many companies to understand that space is needed. And often it can be large businesses such as Amazon that are buying that space and converting it. But absolutely, we are seeing a trend, particularly in the trading estate that we sit on the edge of, to more warehousing, certainly real estate being created, which will lead to businesses obviously filling those with products and goods, either that are manufactured in the UK or that are imported into the UK. I think, to answer the question in relation to are there any typical structures that I think when you start to get into the realms of fairly large leases, developing property, entering into leases for warehousing space, it'd be very unlikely that wouldn't happen for a UK company. I think pretty much every company would want to ring fence those risks and liabilities from a UK perspective. So certainly every business that I have seen that is moving down that path has set up or already has a limited company here in the UK, rather than that being a branch or some direct form of investment from a foreign entity.
Okay, and then just one follow-up question. What is the minimum level of, let's call it, substance activity that you need in the UK to make it work? Is it, for instance, sufficient that you have a corporate service provider taking care of directorship, or do you need an employee for a particular amount of hours per week? How does that work?
I don't think there's a particular amount of hours per week. I mean, there are some practical considerations, and Tony kind of alluded to some of these earlier on, from setting up things like bank accounts, where it's almost a requirement to have UK employees or a UK-based director here in the UK to be able to do that. So I think that's probably the minimum threshold. It's very likely there's going to need to be at least one, if not a couple of UK-based employees.
Okay, thank you.
Well, maybe I have to go back to Dan, because another question came in from Thea, and it's about still the DDP. The deliveries, she asks the question about the deliveries DDP to the UK, which party needs to be, and then I don't know what that means, GBEORE number. Is it the broker or is it the logistic party that needs to have this?
It's, if you're doing it under DDP terms, it's the supplier that needs the UK EORI number. Unfortunately, your EU EORI number will no longer be valid in the UK. But again, it links into VAT registration. You can apply for an EORI number at the same time and have it just linked to your VAT number for simplicity. But from a practical point of view, what tends to happen is when the goods are imported into the UK, if there isn't an EORI number, it just goes under that of the kind of the logistics partner, as you mentioned. But that does then create problems in terms of recovering the VAT at a later date.
It takes more time than it used to?
No, it's not so much that. It's just to be able to recover the VAT in the UK, you need to be able to link it back. So when the goods are imported in the UK, we have a kind of a certificate which gets given to the importer of record, which is linked to the EORI number. So unless you're using your EORI number, you're not going to get the certificate, and therefore the UK tax authorities are likely to block the refund of any import VAT that might have been paid.
All right. Thank you very much for that, Dan. Well, since I have no further questions in the chat box at the moment, I think I would like to thank the three of you for hosting this webinar on behalf of Carpenter Box. As I mentioned before, if people have questions, they can contact one of the three of you straight away. Information is on the sheets, and we will, if somebody wants to spread the sheets, at least they will be available. So thank you again, guys.